I think it's important we look at how real estate investment trust, generates dividend income for their investors. How do they generate dividend income for their investors? So you look at it under these items. Number one is high dividend payout requirements. High dividend payout requirement. According to the law in the US, real estate are expected. These firms are expected to pay out as much as at least 90% of their taxable income as dividends. So when you invest with them and then the rents come in, the rental income comes in, and after expenses and liabilities, whatsoever is generated, the company is mandated to pay you at least 90% or whatsoever the company generates as income. And so this mandate ensures that investors regularly receive a significant portion of their earnings, making them a reliable source of income. So it's a very, very nice arrangement, actually. Paying out as much as 90% is quite commendable. Number two is a consistent income stream. Real estate investment trust generate income primarily from rental payments, from lease agreements, as well as mortgage interest. These steady revenue sources provides a consistent cash flow, which is passed on to investors as dividends, making REITs attractive for those seeking regular income. So they get their money through, rental payments, through lease agreement. When they lease a particular building, they get money, and also through mortgage interest. They may equally offer mortgage services. The interest that comes in, equally goes to their investors. Number three is above average dividend yield. Above average dividend yield. Compared to traditional stocks, you discover that real estate investment trusts offer a high dividend yield, appealing to income-focused investors looking for regular income. So REITs typically, yield more than bonds or dividends-paying blue chip stocks. They yield more than stocks, actually, offering competitive returns, in an income-generating portfolio. So their returns are highly competitive, particularly when the real estate sector is doing quite well, is doing very well. The investors will stand to benefit maximally. Number four is diverse income sources. Diverse income sources. Real estate investment trust, invest across various property sectors such as residential, commercial, industrial, healthcare, and retail, as well as even hospitality, sector. This diversification, spreads their risk and enhance the stability of the dividend income. Even if certain sectors, experience downturn, other sectors could be doing very well because the fund is adequately diversified. Please like this video and subscribe to this channel. Number five is tax advantage for dividend income. Tax advantages for dividend income. So in many countries, you discover that real estate investment trust, the dividends they give, they pay out, qualifies for special, tax treatments. They qualify for a kind of, a level of exemption when it comes to tax. For instance, in the US, shareholders can claim 20% pass-through deduction, reducing the effective tax rates on dividends and enhancing, income and enhancing their, their after-tax income. This particular provision guarantees 20%, pass-through deduction for the investor. And by so doing, the tax burden is kind of lesser, on the investor. It's a very nice government policy. Number six is inflation protection. Inflation protection. Real income, rental income, often rises with inflation. That's a wonderful aspect of this kind of investment. Unlike the stock market, where you are affected by inflation. In the bond market, the bond yield or the bond coupon may not really cope, may not be able to cope in an inflationary environment. When it comes to real estate, discover that the rental income often matches inflation. In other words, whenever there's inflation, landlords will tend to increase their rents. So real estate investment trust offers the convenience of a stock-like liquidity, kind of. And so there's that particular, apart from offering liquidity, there's this kind of inflation-linked growth. There's that particular growth, ensuring that investors' income keep pace with rising living costs. So I think it's a general kind of rule. I wouldn't know precisely. Landlords tend to raise their rental income, their rents with inflation. When inflation goes up, they tend to raise their rents, and by so doing, the investors are able to have a kind of return that could cope with inflation. They will not have their returns, their returns could adequately keep pace with inflation. So number 7 is accessibility and liquidity. When it comes to liquidity, you discover that very easily you can sell your real estate related stock in the stock exchange, just like you buy other equities. You can very easily buy and you can seamlessly sell your holdings. So the liquidity is adequately guaranteed, actually. So this accessibility is easy to buy, to access the market, as long as you have a brokerage account. And not only that, it's equally very easy for you to sell if you want to liquidate your position. Number 8 is its long-term dividend growth potential. Long-term dividend growth potential. So many real estate investment trusts focus on acquiring high quality properties and expanding their portfolio, which can lead to dividend growth over time. They keep on acquiring additional properties and they are growing their property portfolio. So the more they grow their property portfolio, the more they accumulate rental income and the more their investors will benefit. This growth can compound returns, especially for investors who reinvest dividends. And so as you reinvest your dividends in the fund or in the stock, as the case may be, discover that you have that compound growth over time. So in conclusion, real estate investment trust plays a vital role in generating dividend income, offering investors a combination of regular payout as well as some potential tax benefit because of that 20% pass-through deduction rule by the government. They tend to enjoy that particular advantage. Not only that, there's equally opportunity for long-term growth. They are particularly appealing for retirees and income-seeking investors and those looking to diversify their income stream without directly owning properties. You don't want to be involved in the hassle, in the burden of owning and managing properties. So this is the right investment for you. You can buy in the stock in the stock markets and you enjoy the dividend that comes in regularly.